All right, let's go ahead and get started, and I'm sure others will be trickling in as we kick this off here. So just wanted to say how excited I am to have this group here today. I think this is one of the most interesting groups that could have a discussion around crypto right now. A lot of headlines that I'm sure people have questions about and are curious how that's impacting crypto in the credit union space, which is what the topic is going to be today. And I'm going to allow everyone to go around the horn and do intros here. But from my standpoint, it's really exciting to have an actual credit union on the call alongside the NCUA and one of the most respected consultancies that's leading a lot of these RFPs for credit unions, SRM. And then with CryptoFi, we have our chief compliance officer as well. And for those of you that don't know who CryptoFi is, we're providing crypto services to credit unions. So good group here of a regulator, a vendor, a consultant, and an actual credit union. So we're excited to get this started. Let's go around the horn. I'm just going to go down the list of who I see at the top. So Patty, would you give us an introduction to kick this off?
Sure thing. Thanks for having me. This is Patty Wubbles with Strategic Resource Management, or SRM. And we have our digital asset advisory team that helps financial institutions, credit unions specifically, explore more education, more strategy, choosing the right vendors, full due diligence process, and really help roll out any interest in digital assets and different use cases that they can explore. So thanks again for having us.
Awesome, absolutely. Christy, I see you next. Go ahead.
Yeah, good morning. I'm Christy Evans, Chief Compliance Officer for CryptoFi. Spent the majority of my career in traditional finance, directly related to BSA AML compliance. Made the big transition over to digital assets back in 2019, working for a blockchain analytics firm, and then transitioned over to a Bitcoin ATM kiosk company. So I'm excited to be here, excited to learn from Vice Chairman and the other panelists, and look forward to the discussion.
All right, very good. Josh, you're next.
Good morning, and thank you for having me, Vice Chairman Hauptman. Great to be on this call with you as well. As a former NCUA examiner, very appreciative for what you and the rest of the board have been doing and the approach that you take. I'm the Vice President of Strategy at Frankenmuth Credit Union, located in Frankenmuth, Michigan. Over $1 billion in assets at this point, over 25 different locations, serving our communities, over 64,000 members. Before my time here, I was an NCUA principal examiner for about 7 years. So kind of bringing that perspective to the credit union as well. Looking forward to this conversation. Thank you.
Awesome. All right, Mr. Vice Chairman.
All right. Yeah, so Kyle Hauptman. I am one of 3 board members at NCUA. That's the National Credit Union Administration. We are the government body that ensures deposits at all 5,000 American credit unions. It's the same insurance that FDIC does for banks. We are also the regulator for 3,000 of those 5,000 that are federal charters. The rest are state charters. I have a term that's 3 more years. The way it works is, again, we're a 3-member board, unlike the SEC, which is 5, for example, or CFTC. I was appointed by the president and confirmed by the Senate in 2020. And have a term that expires in a few years. And I serve with my fellow 2 board members who have been great to work with. And thank you for having me today.
Absolutely. So let's dive into this discussion. We've got a lot of topics that we want to get through. We are going to hold off on questions for today's session. If anyone has questions after this for any of the panelists, there will be an email that's going to be sent out, and you can ask those questions over email, and we'll be sure to route you to the right place. So without further ado, Mr. Vice Chairman, I think we'd like to hear from you first on this first question. For a credit union that's thinking about launching some sort of digital asset solution from a regulatory standpoint, what are some of the key considerations that a credit union should be mindful of and paying attention to as they're evaluating launching some sort of digital asset solution?
Well, thanks for that. Part of the answer is the same as any partner, right? Due diligence. It's on the credit union, right? My philosophy, I always say, listen, we're not your mom, okay? We know there have to be experiments. We also know there's going to be problems. There is with any new technology. But like with any partner you're with, it is on the credit union CEO and the board that supervises them They pick who they partner with. And I think we've seen the last year, management dig deep in the books. If they won't let you see them, you've got a problem. You are responsible for who you get together with. Make sure everything works. Do a test trial, that sort of thing. Do a small dollar amount. If you're going to lend, do a $5 loan. So if it goes bad, test everything. If somebody says we don't rehypothecate, well, all right, so, verify that. And we've seen this year that it's like a lot of gold rushes. When there's a new technology or a new thing, there was a lot of gold in the gold rush, a ton of it. The problem is there were too many people going for it. And this crypto winter we've had this year, just to use an expression, it serves a purpose. I grew up in the national park system. My dad was 35 years, and the federal government policy is to not put out forest fires that are naturally occurring, like from a lightning strike, because they are part of nature. They serve a purpose. They are not fun. They are brutal if you're an animal that lives in the woods or a human that lives nearby, but they are part of nature. And that is what bear markets are doing. They're shaking out bad management. So the upside, I think, for somebody getting into it is bad business models, or maybe just too many people pursuing the same dollar have shaken out. But I know that's a long answer, but the main thing is, credit union CEO, this is on you to do your due diligence, who you get together with, who you partner with, that is on you. So, and the market's doing some of the work for us, but still, it is on them to check it out. Regulatory wise, as far as if you're talking about crypto assets themselves, the people buy and sell, now what is or is not a security? What is or is not a commodity? What exchanges are supposed to be SEC registered or not? None of that is NCUA's purview. Those are other agencies. So that's something to be aware of that we cannot help or hurt you with, right? That's on you.
Yeah, that's a fantastic insight there. And before we go around the horn, I just want to circle back to one thing that you said around rehypothecation. I think that's a term that has been thrown around a lot more recently in the news, given the events that has happened. So for those that are not familiar with what rehypothecation is and how that's really impacted some of the events that we've seen in the headlines, would you mind just explaining that a little more, Mr. Vice Chairman? Yeah,
it just means when there's a collateralized loan, right? So a mortgage is a collateralized loan, meaning they can take the house back if you don't pay. A car loan is collateralized, meaning they could repo your car back. Securities are often lent out because otherwise there's no way to short sell them, right? And so I lend Josh money and he gives me his crypto as collateral. I then lend that to somebody else who needs it because I earn a fee on that, some of which I may share with Josh. That person lends it to somebody else. You might even owe it back to yourself and not even realize it, because I owe it to, I owe it to Josh, he owes it to Christy, she owes it to Patty, and it comes back to me. So a lot of us in our brokerage accounts may get a small little piece of income on securities lending because they lend out your stock shares. So it's not that unusual in the securities world, but we're kind of in new ground. I think for a stable coin, for example, trying to make sure that what they call proof of reserves, that for every dollar in stablecoin, there's one US dollar, and they are like conjoined twins. At no point ever, is that stablecoin lent out to somebody else, Anyway, so rehypothecation is just lending something that's already been lent to other parties, right? It's a normal part of normal securities markets, but it can cause issues, Josh says, hey, I want my crypto back. Here's the money for the loan. I say, hold up, I got to get it back from the other person I lent it to, right? That's rehypothecation right there.
Yep, and that's exactly what we saw with FTX and really what started this whole mess over the last couple of weeks. So great insight though, Mr. Vice Chairman. And Patty, I want to redirect sort of the same question to you. I mean, when you're helping evaluate a crypto program for a credit union, what are some of the key things that you initially advise credit unions on?
Yeah, I think the key considerations, even taking it a step back, is making sure that, especially right now with everything that's going on, the crypto winter, all of the headlines, all of the things you can get wrapped up in your own personal views, as well as the hype of the headlines. And I think that for the consideration part of it, you really need to be informed. Definitely continue the education process. This is a whole new area, so that's an area we try to focus on, is what is crypto, what is distributed ledger? What are all the use cases? And really exploring that and not being paralyzed by some of the crazy stuff that's going on right now. And that's a really hard thing to do. Takes a little bit of courage. It takes a little bit of forethought. It takes a little bit of where this is all headed. History repeating itself a little bit when you think about the .com and some of the creative destruction that went on there, that eventually became a paradigm shift. So you really have to be able to do your fiduciary responsibility and be able to look at this and how it's changing the entire environment, educate yourself, find out what use cases make sense, and the due diligence part absolutely is part of that, and really asking and following up on the important questions and not leaving it to your core processor or your online banking provider. Your staff need to make sure that you're on top of all of that.
That's fantastic insight, and I think it's great that we have Josh on the line here who can give us some firsthand experience of what Frankenmuth has gone through as you started evaluating your crypto offering. Josh, if you could maybe just shed some insight for the folks on the line here around where Frankenmuth really got started, and how you've made it to this point really today, where it seems as though you guys are going to be moving forward with some sort of digital asset solution. So
yeah, I think we would start with what Patty said, which was education. And so from management team throughout the organization, figuring out what is crypto, and kind of exploring it from there, the various use cases. But then also going back to our membership and saying, is this even something our membership even wants us to explore? If we're $10 million credit union, maybe this isn't the right thing for them, and maybe it is. But I think that the bigger membership you have, the more exposure you're going to see in this space, and we definitely saw exposure there. And so between those two, between the education and the need to meet membership needs, we kind of started forming a strategy and okay, how are we going to approach this? And I think there might be some credit unions, because I know we had this conversation too. Well, maybe funds aren't leaving the credit union, and I think more funds are leaving institutions than we realize. And you can go through data processor and see, well, it's going to Coinbase or it's going to MoonPay or it's going to Ramp or those things. If your FI even lets those transactions go through, some of them block them. But what you're not seeing is those transfers to other institutions and then ramping from there. Because there's a lot of limits on these different platforms. And so I think even the funds that you're seeing leave your institution that are clearly you can see leaving, it's exponentially more because people are going around you to onboard those funds as well. So we gauged our membership interest, which is kind of tough to do with 64,000 members. But there is definitely an interest there. And so then from there, we gauged the regulatory environment. So we listened to Vice Chairman Hauptman's presentations. And we gauged the regulatory kind of environment for what's permissible, what isn't permissible. Then once we were able to clear those two, I think it's strategy stamp. It's strategy point, right? I mean, now you start formulating a plan. What are our membership needs? What are they looking for? Because not everything's going to fit into what you need. But those were the first two things that we looked at was after education, membership, regulatory environment, and then kind of proceeding with strategy after that.
And that makes a lot of sense. I mean, it sounds very similar to how a credit union would evaluate really any fintech, I think, not just crypto, right? So I think that's interesting to hear that. I mean, your approach really isn't that much different. And I think that to me is a good takeaway from this, that, crypto, once you start to peel back the layers, maybe it's not so scary once you can actually understand what it is you're offering and how you're going to go about offering it. So great insight, Josh. And Christy, being the only vendor on this call, what are some things that you've been working on to get credit unions, I think, more comfortable with launching some sort of digital asset program?
Like Patty and Josh said, education is key. A lot of, from a personal perspective, from a compliance officer's perspective, that they may not know what Bitcoin is. They may not know what a digital asset is. They may not know the process for evaluating and identifying unusual behaviors within their transaction monitoring platform. So I feel the compliance officers need to be brought into the initial conversation. They need to understand the risk involved so they can establish an appropriate risk assessment based on the credit union's risk tolerance and go from there, so that they are brought in the beginning so they can understand what they need to do from their perspective.
Absolutely. That makes sense. I think one of the interesting topics that we've probably seen a lot of memes about and in the headlines is the adage of, not your keys, not your Bitcoin, or not your crypto. And I think that's a really interesting consideration. But what I don't think we see enough in the news is the benefits of using a qualified custodian, and how that could potentially plug into a credit union to help keep members' digital assets safe. So when Patty, you want to direct this to you first. When you're helping a credit union evaluate a digital asset offering, what sort of education do you provide to them, or what could you provide to the group that we have here around the role of a qualified custodian in a digital asset program?
So we have, because again, this is a brand new space, what our team is doing is helping through that full RFP process. So there's hundreds of questions that could be asked dependent on which avenue that the credit union might be going in. And I think another, to go back to your first question too, is it's not just crypto. It's a payment system, it's an investment system, it's a distributed ledger, it's a technology. And so part of that information is all of this is coming in at once, and that's a challenge for credit unions. So when they're going down a specific avenue and they've identified that use case, as they start talking to, and there's options. So the first and most important part is you have options of who you want to partner with. It does not have to be dictated by your core or your online banking provider, although integrations might be there. And so that'll be super important. But then it's asking those questions in an RFP process, like liquidity, making sure that, and this will come as part of the regulation, is finding out, is it auditable? Is there regulations in place that help with consumer protection, that identify that auditability piece, to know that liquidity, proof of reserve, proof of liabilities, things like that, that'll be important. And you'll need to ask your provider, your third-party partner, do you have these things, and show them to us. That's all, it goes back to all of the due diligence pieces of it.
Absolutely. And Mr. Vice Chairman, I see you're nodding your head there. Would love to get your comments around that. Same question.
Just checking all those things. Listen, I don't know about you guys, but I've used the internet for a couple of decades. I have no idea how it works, right? And if I had to speak to my younger self from 20 years ago and explain what a smartphone is, I wouldn't go into 5G wireless and gigahertz and telecom spectrum and satellites. I'd say, oh, it does all these cool things. I need a ride at night. I hit a button and a guy in a Hyundai comes and picks me up. It's really cool. I have no idea how it actually works. It beams to space or something, right? But, and it's core to our lives, right? And so, Patty mentioned the dot-com boom, same thing. A lot of people first heard the phrase .com or heard about the internet because of CNBC, because of stocks, because the Netscape IPO tripled on the first day. And then, it was there, a gold rush, and things are overvalued. Fine. Let's just put that aside for a minute. When the dot-com world crashed in 2000, and a lot of investors lost a lot of money, was this new thing called the internet, the World Wide Web, was that a fad? No, that was not a fad at all. Investors caused a bubble, and they always will throughout history. But it was a tool, and credit unions used it. So to Patty's point, yes, there's buying and selling and holding, and that's interesting. And I'm glad that we provided clarity for credit unions to do that, because as Josh said, they saw the money leaving and they weren't collecting a toll on the way out. So it's a source of non-interest income if they want. But as a tool, just like the web, right? Did credit unions invest in .com stocks? No, but they did get a website. Now they have mobile banking, they have online bill pay and all this stuff. So distributed ledger, as Patty said, blockchain, the core of it, if you're nervous about the investing side, there's lots of other interesting things, the same way the internet changed your business, even though you didn't buy any stocks as a credit union, right? Title, what do credit unions do? Car loans and home loans, over 85% of the whole system. What do they both have in common? Title. If you're getting a loan, that means you don't have title. And title transferring. I don't know about you, but I consider in most of this country, I find the real estate title process to be bizarrely creaky and very expensive. Title insurance, I have to pay in America, in this century, in the home of Silicon Valley, I have to pay a whole bunch of money to prove that the property I bought from Josh was actually Josh's to sell to me, Anyway, so there's stuff like that, settlement tokens, that sort of thing. But I want to reiterate about rehypothecation. Josh, may I ask you a question? In your offering you're doing, did you check on rehypothecation? that when someone buys $1,000 of Bitcoin, there is $1,000 of Bitcoin sitting there 24 hours a day?
So,
I don't want to put you on a weird spot.
yeah,
Right?
I'm not in a position to discuss our.
Oh yeah, all right, that's fair. But it doesn't matter whether it's Josh's credit union or not. Bank runs like we saw, like with FTX, right? So just a little history. Deposit insurance, what NCUA does, was created because of bank runs in the 1930s. That's when Franklin Roosevelt made the FDIC. And the whole reason was to stop, bank runs, which is there's a rumor going around the town that the bank may go under, everybody rushes to get their money out as soon as they possibly can. And no bank or credit union in this country could give you all your money all at once if every single person wanted it the same day, right? So because of deposit insurance, you don't have those concerns. Even if the bank go under, and they do all the time, you still get you're made whole on your deposit. So there's no matter what you hear about the bank, they got issues. There's no reason to run and take your money out. Okay, so it stopped that problem. Crypto is old school, where it's not insured. It's not going to be insured. It shouldn't be insured. So it's very important that you partner with someone where they don't hear about, like what happened with FTX. FTX had a lot of problems, but what popped the balloon at the end was people hearing they have problems. Oh, let me go get my money out, and they didn't have it on hand. Okay, and I always say, if you've ever played blackjack at a casino and you get a chip, the reason the $10 chip you treat as if it's 10 US dollars is because you assume at any point you can take that chip and switch it for cash. You can go cash to chips, chips to cash. If at any point a rumor got around, that Caesar's Palace or whatever didn't have the money, everybody would take their chips and sprint to the cashier to try to get their money out, as soon as they could. So the old school bank run problem that deposit insurance started in the 30s, that created deposit insurance in the Great Depression. It's very important that you're dealing with a crypto vendor that has all of that sitting right there all the time and can prove it, because there's no deposit insurance on that. So the only way to stop a bank run is to have complete confidence that anytime I want it, 24 hours a day, me and everybody else can go get it at once, and we'd have no problem. I wouldn't do business with anybody that could not prove that 24 hours a day, because there's no deposit insurance. And the only way to stop a bank run is to make sure everybody knows all the time, your stuff is safe. You could all come get it today. It'll be no problem.
That's great color around this topic. And I do want to circle back to some of the other use cases, but just staying on topic right now around the buy, sell, hold use case, which seems to be the easiest for a lot of credit unions to get started with. Christy, as the vendor, would love to hear what you're looking at in terms of both making sure, like the vice chairman was just saying, that you can prove that those digital assets are actually sitting there in a safe place. And then, one of the things that I think is interesting to see that, I've noticed over the last few months is some of the qualified custodians are actually providing insurance now, which hasn't really been a thing in the past. And so, Christy, if you could just maybe provide a little color there on what you're seeing there too, where, FTX clearly didn't have insurance on those digital assets, and that's why all the users are in a really tough spot right now. But could you provide a little color on what you're seeing there, Christy?
Yeah, recently in discussions with some of the custodial partners that we plan to partner with and currently partner with, they do have wallet insurance up to a certain amount. And once a specific wallet for a financial institution or credit union reaches a certain amount, they will create a new wallet, providing additional insurance for the full wallet value, if you will, up to 10 million. So I found that quite interesting. And I think it's important to note that there is insurance there for those wallet solutions with these custodians.
Christy, may I ask, what is it insuring against?
They are insuring against any loss or theft.
Like a hack, right?
Keon, you may have some more insight into the coverage.
Yeah, Christy and I works closely on some of this stuff. So
okay.
The thing it does not insure for in most cases is a bankruptcy. But with some of the custodians, they will have segregated wallets where the users would be able to access their digital assets directly if there is some sort of financial issue And if there was some sort of bank run, if there's the right protections in place and you're working with the right qualified custodian, then that can give the credit union member some additional assurances. But it's not a perfect world that's out there, and that's why I think the diligence piece is especially important whenever you're evaluating this. So, any comments on that, Mr. Vice Chairman?
Just it's good to see those solutions, and technology's changed. People don't. What you can do is investigate your partners, their finances, their history, put in call, right? And there is no substitute for an educated consumer on this stuff. You don't have to know the core of how like Bitcoin is mined or anything, but because the technologies are all going to change, the people don't. There will always be scam artists and just sloppy business models, or sometimes businesses just fail because the market wasn't there. It isn't necessarily anything bad, but that will be true, throughout all of human history. So the human side of it, you don't have to know the technology as well, but the background. I think it's interesting that they have those. So some more color, if I may. In the securities investing world, the regulated, mutual funds, stocks, bonds, there's an equivalent of NCUA called SIPC. And that is, if I have an IRA at Fidelity and it's in a, Vanguard fund, if Fidelity goes out of business, I still get the full value of my IRA. I don't lose $1 of that. SIPC, the government agency, makes me whole, and they only will insure it after checking out how Fidelity segregates the assets. So you don't have to get in line as a creditor at a bankruptcy like everybody else. It's sitting there for you all the time. They just come in and say, all right, you guys got your bankruptcy. That's between you and your creditors and your shareholders. That's over there. Can I just have the customer assets that are segregated and nice and safe? And they take those and go away in the bankruptcy, and then you wind up transferring it to another brokerage or something. They only insure it after making sure that can happen. Otherwise, you wouldn't insure it. It also obviously does not insure you against a loss, right? If my funds go to zero, I lose all my money. That's not insured. You don't protect investors against loss, just whether or not my custodian goes out of business. So the insurer here is important because if they're a good insurer, they should be doing their due diligence. Check on them. So insurer is only good as how much, as how good they are at it. They should be doing what SIPC is doing and making sure, hey, I'm insuring all this, and I got to make sure that if everything goes south, I can go and grab it easy and next day. So I think that's important to know that that insurance out there, that's a good, healthy private insurance market. But I would check out the insurer too. That's interesting. It's not going to protect you against loss, and it's not going to protect you against the entity going down, but you should be able to get your stuff back, I assume.
Yep. And that's I would argue that everything that's happened in recent weeks is actually a good thing for the crypto industry in the regulated space. Because if you're a user out there, you're gonna have a lot of hard time trusting any of these other third-party crypto exchanges that we're seeing this domino effect right now. What's happened from FTX. So I think
this is what markets do. I mean, nature is healing itself. Yep. Warren Buffett, you don't know who's swimming naked till the tide goes out, and that's this.
Absolutely. So circling back to just some of the other use cases as well, I think most people agree that buy, sell, hold is likely a use case that will be explored. But you mentioned some other interesting ones around real estate. And Josh, I want to direct this one to you. Going down the path of evaluating your own blockchain or crypto solution, was buy, sell, hold the first thing that you all had talked about, or was there other use cases that you identified as well? If you can just sort of share some of the thought process of your credit union and how you've thought about use cases, I guess, beyond just buy, sell, hold.
Yeah, so buy, sell, hold was the initial. Let's take a look at that. And I think it's an easy entry point into the space to gauge what your members' interest is. And so if there's a huge interest in that, let's partner with a third party who has a roadmap that's maybe a little bit further out. From my perspective, buy, sell, hold is fun to watch, but it's not the full use case of the technology, and probably not even the major part of it. But it's fun to watch, and it is a crypto solution. But I think partnering with someone who has a roadmap of, okay, now we have buy, sell, hold. What are we going to do with it? Can you go and spend it? Can you transfer it? What does all of that look like? And so it was buy, sell, hold, but it was also, okay, what's coming down the road, short term, long term, where if our members are really interested in this, what else can we do with it?
And was there any particular features that jumped off the page from feedback that you heard from your members that you're excited about on your roadmap?
So the ability to use it, transfer it. Again, that's outside of the buy, sell, hold, but actually using it not as a speculative investment, but as a vehicle of transferring monetary value or transferring value. If that's the way that we see the world going, which I think a section of it is, enabling our members to do that with a trusted third party, I think is the way to go. So that was something that we looked for on the digital roadmap, and very happy to see that.
Makes sense. And Patty, sort of the same question to you. You obviously talk to a lot of credit unions out there, and the evaluation piece that you referenced earlier, I think, is obviously incredibly important as a first step to making sure you're rolling out something that your users are going to be interested in. So, how do you walk a credit union through evaluating use cases, and are there any in particular use cases that you've heard more interest in than others beyond just buy, sell, hold?
Yeah, absolutely. And that's where the education comes in, because everyone talks about the buy, sell, hold because that's what everybody talks about. And so that's what they want to talk about. As you start to learn more of what all the capabilities are, then you get a credit union that may not be interested in doing buy, sell, hold, and you don't want to cut it off just because of that. Let's explore other use cases. Maybe they're interested in rewards or roll up. Maybe they're interested. We've got some clients that are not doing anything from a retail standpoint right now until it settles it down. Maybe cross-border remittances or things like that offer to their members. That's helpful. But they're looking at lending, or they're looking at back office efficiencies that help the credit union itself. Whether it's dabbling a little bit in the DeFi space, and again, regulation's important for this part of it, but it's exploring all these different areas that can help with the member experience. At the end of the day, it's member experience. It also helps the financial institution. So in the example that Kyle talked about earlier with buying a house, if you can shorten that buying house experience from, in my case, 2 months to 2 weeks or 2 days, that's going to be great for me as a member, and the financial institution gets to book more loans. If I don't have to go through the title company and pay $600 for someone to tell me something I already know, all those friction points along the way might be the use cases. And the point about that is, as credit unions learn more, you have different business units across the whole spectrum that start to say, hey, what about this? What about on our cash management? We offer something to our commercial, to our commercial customers who have immigrant workers that are trying to send money back to their families and are using predatory Bitcoin ATM machines, or what can, so looking for those friction points and then saying, this is where we want to hone in on first, but don't throw the baby out with the bathwater. If you're not into the buy, sell, hold right now, explore, keep learning, and identify what your use cases are.
And Kian, if I could just add, I'm sorry to
Please
add, if we could frame what Patty just said and play that as a recording, I think that's it. I think that's totally it. I mean, education leads to innovation, and the credit union industry kind of needs that innovation. And so the more that we educate, not even users, but the more that we educate credit unions about the technology, we're gonna see the brightest rise to the top, and we're gonna see immense innovation in the space. So everything that Patty said rings true. And if we could just frame that and replay it, I think it kind of hits everything.
Well, luckily for all of us, this is a recorded session, so everyone will be sent the.
And credit unions always have, right? Credit unions were early on ATMs back in the day. They've always innovated. They had to. They were the original solution of financial inclusion. You wouldn't start a credit union with a field of membership if you were satisfied with your other financial service offerings. What Patty said about remittances, there are credit unions down by that are even close to the southern border who would like to do remittances, but it's difficult and it's clunky and it's a pain. And as a result, their members are paying an enormous amount of money. And can you imagine trying to send money to your mom so she can pay, the rent, and you're doing jobs I've done, like washing dishes, and a huge chunk of it, 5 hours of your labor got chewed up in fees to send back. Because the most brutal thing to send money is small amounts. That's where you get killed, right? Trying to send $80, back is brutal. And so there's some really neat things. And financing is generally about payments, money going in, money going out, making a loan, payments, people paying bills, and settlement tokens and that sort of thing can make a lot of this much easier. We don't have to live in a world where if you Venmo me money on Saturday of Memorial Day weekend, I don't get it till Tuesday because Monday is a holiday, right? I mean, we don't have to have that problem. I don't think anymore. You can do it 7 days a week, 24 hours a day, quickly and extraordinarily cheaply. And, you know, I'll just say this, my sort of true north as a regulator, I always say is, I don't want to see credit unions go the way of Blockbuster Video because their regulator wouldn't let them compete, okay? Now, there are some sort of DeFi, decentralized finance maximalists who think that the whole traditional finance, TradFi, is going to go away. Okay, maybe they're right. But my job is to make sure it's not because we wouldn't let them innovate. And people say, are you worried? You know, there's gonna be problems if you let them do stuff. And I said, well, actually, I know there's gonna be problems. You know, did you know there was 0 plane crashes before we had planes? Not one. Serious, not one. Thousands of years. You know, you could go down the list. You never had a computer virus before we had computers. I know there'll be problems, but the biggest problem, you know, is, pick your analogy, slamming into the iceberg, you know, turning left maybe has some issues, turning right has some issues, you know, it's terrible. Keep it on the same path. So, you know, it's good to have responsible people in it who help with, you know, the hand holding that should go into this, the due diligence. Again, technology's changed, people don't. There's going to be partners you want to get with and partners you don't. So I appreciate the work you guys are doing.
That's great insight. And, you know, just thinking more about the other use cases beyond just like the buy, sell, hold of just Bitcoin. I heard several from both Patty and Mr. Vice Chairman here and Josh. So, you know, if we think about some of these other use cases that are not related to buy, sell, hold, like you mentioned, like remittances or anything that's related to a stable coin. In your regulatory purview, Mr. Vice Chairman, are there any other regulatory considerations that a credit union would need to be aware of when evaluating doing something other than just buy, sell, hold? For example, if they were to do, you know, use a stable coin for remittances or for settlements or for payments, something along those lines, is there a unique set of guidelines or just any regulatory guidance that you could give a credit union, or is it the exact same from what you said earlier?
Well, it's all the same stuff done, you know, AML, BSA compliance, that sort of thing. You know that already, and it should make that easier. A stable coin is something you can buy and sell. Now, in theory, you know, a dollar gets you a dollar, so you're not investing in it, right? Because, you know, it's not supposed to go up. There's no expectation of profit. But, you know, you don't know what other agencies are going to rule on these things, like who can issue a stable coin, who cannot. The good news is, as of this moment, there's nothing breaking any rules about using a stable coin for settlements. It can reduce fraud, make it much easier, et cetera, make it easier for a small credit union to survive because you don't have all the people power, a fraud reduction. There's a number of things you need to think about. I mean, it always goes back to due diligence, and I can't predict what other agencies can do, but I want to say this. So we did put out guidance related to third-party buy, sell, hold last year, partly because from my standpoint, that was an easy one to get done. Credit unions were already doing it. You know, it didn't break any rules. And the reason we put out guidance and not a rule is because it didn't break any rules. You didn't have to put out a rule. It didn't. So, and then to follow that up, we decided this past May to put out broad principles, okay? And instead of doing this, we don't want people to wait for this use case, that use case. You know, listen, if you desperately need guidance on a personal use case, then reach out to us. But in May, we put out these broad principles. There's this new thing, distributed ledger. It's pretty neat. It's gonna have various use cases. We didn't even want to list examples because the way it is with the government, people, if you list A, B, and C, people think you can't do D and E. And I'll say this, you know, I'm a Republican nominee, and but that broad principles, this thing exists, it will have uses, go forth and experiment. You know, if it's not breaking a rule, it's not breaking a rule. We're acknowledging the use of this new technology and taking a different approach than some of the other regulators did on it, okay? The reason I mentioned partisan politics is, again, I'm a Republican, but what I based that on was what I consider to be the best piece of DC economic policy making in my entire lifetime, which was 1997, the Clinton Gore administration put out principles for this new thing, the internet. And they put it on whitehouse.gov. It was just principles. Whitehouse.gov itself had only existed for like 2 years at that point. And number one was the private sector shall lead. It was a signal from up on high, from the White House to all concerned and all the agencies, the Treasury and everything, that we want to let this thing blossom. They were put up 5 principles. It's kind of funny to read it now if you go back and Google it. You know, the information superhighway, that's what they called it. That's what Al Gore always called it. And we know what happened next, right? America won the internet. We got all the disruption just like everybody else, but we got more upside. The most jobs, the most investment, the most headquarters. If you wanted to work in the .com industry, you wanted to be in the United States. If you want to get on the best investment opportunities, you wanted to be in the United States. If you want a headquarter company, you wanted to be in the United States. The thing that's the worst possible from a policy standpoint is when something's disruptive is to get all the downside and none of the upside. We lost all of our Blockbuster video rental jobs, you know, so did everybody else, so did Canada, so did Mexico. Everybody lost those jobs, but we at least got Netflix headquarters, Hulu headquarters, the people who got in on the investment rounds, the employees that got stock options early with life-changing wealth. If it's disruptive, you're gonna get the downside. The question is, does your policymaking framework allow you to capture as much upside as possible? So I don't want to get sort of theological there, but that's
that's fantastic. And I think I want to ask you just one more pointed question, Mr. Vice Chairman, just to make this abundantly clear for credit unions. So does a credit union need any further guidance from the NCUA to proceed in a buy, sell, hold digital asset offering to their members, or is lack of prohibition enough?
I would look at the guidance we put out about a year ago, I believe, end of 2021. And the reason, again, it was guidance is because it didn't break any rules. Credit unions were already launching these things. And from their standpoint, the risk, like if it doesn't break a rule, why wouldn't you do it? Well, the one risk you have is, especially for something new, is that there's about to be a rule. And it doesn't mean you get in trouble if you stop. It means you wasted a whole bunch of time, right? And money, right? So that's the risk. That's the point of putting out like our May guidance. One thing it does is it means it signals we're not about to put out the reverse. You know, please stay away from all digital assets until further notice, right? And that is what the banking regulators have done. They say you have to get written notice of non-disapproval first, okay? So, you know, maybe that's the right way, but, you know, we've taken a different approach, which is if it doesn't break a rule, it doesn't break a rule. But that guidance in May, the main thing it talks about is, you know, I think they have to indemnify NCUA against any issue. And, you know, it all comes down to due diligence. You know, management has to do what management's supposed to do. On buy, sell, hold, no. I'm not here to endorse any vendor. I'm not even here to endorse doing it at all. You know, maybe the juice isn't worth the squeeze, you know, for some people. Maybe you spend $100 and get 60 back. You know, that happens sometimes. I'm not here to endorse it, but the main thing is if credit unions think it is a useful experiment, I would talk to other credit unions that do it. One thing I like about credit union world is sort of how cooperative they are with each other as well. They like helping each other out. You know, check out your vendors pretty well.
I think that's great advice. And just to expand on that a little bit here with Josh, a follow-up question for you. I mean, when you were doing that initial evaluation and you ultimately decided that buy, sell, hold was where you were going to start, what sort of data did you look at, or what sort of feedback did you get from members that made it clear for your credit union that this is going to be a path that was going to add more value, that would offset any of the potential risks that Vice Chairman just referenced?
Yeah, I think the biggest metric that we saw was money leaving. It's hard to kind of quantify. I mean, so if you go the survey route, I mean, say you have 70,000, 100,000 members, you get 1,000 responses, you're going to have strong opinions on both sides. It let their voice be heard, but doesn't do a whole lot with decision making. So actually seeing the funds leave was kind of okay. We need a solution here. If the funds are leaving to go to the on-ramp type situations and leaving out the back door, that they're clearly doing a buy, sell, hold type thing. So that's how we went that route. But if I could just pivot a little bit and Vice Chairman Hauptman, I really appreciate the tone at the top at NCUA when it comes to digital assets, and the green light approach of there's nothing that says you can't do it. Just do it prudently, follow what we already have in place, and take that approach. And so from us in credit union land, we very much appreciate that. The concern would then be if there's not specific, and I realize that there is guidance out there, but how does it translate at the examiner level? I mean, so are examiners being trained from the top down on this, or do they have questionnaires that they're going off? Just creators want to follow the rules and make sure we're doing it the right way. Obviously, we're responsible for what we do, but we want to make sure that we're meeting exam expectations.
And if I'm if I'm the examiner and I'm responsible in some manner, right? Because no matter what, we're your insurer, I would be nervous on something I didn't understand, right? Because at the end of the day, I have to give you a report card, and we're insuring your assets. We have to write a check if something goes wrong at Frankenmuth Credit Union. If there's anything that somebody raised an eyebrow about or doesn't know, this is not a great solution, but please contact me directly. This is right, and I can make it broader, and I won't get anybody in trouble. We're all ignorant of most things in life, right? There's thousands of languages. How many do you speak, right? There's a lot of things we don't know. So, and we can make it more part of the training, okay? And the reason I think your question is important, and we need to make sure we're, that the rules of engagement set at the top are followed, on the field. Our credit unions are, there's $2 trillion in assets, right? One of the reasons for that May letter, which it says in the May letter or May piece of guidance, was we're trying to put our hand up and shine a light on credit unions. I'm trying to be like a Pied Piper, okay? To Silicon Valley, venture capital, et cetera. Hey, credit unions are over here. It's a pretty good market. 130 million Americans, $2 trillion in assets. Listen, $2 trillion is a lot of money, but it's also one division of JP Morgan, okay? Credit unions can't afford, and our regulator, your insurer, cannot afford to dissuade people from making cool stuff and partnering with credit unions, because as you know, it's going to be a little different than working with banks. And all else equal, you're going to go for the market that's 90% of the market, not the one that's 10%. Ask anybody who's left-handed what the world caters to when it makes products. It caters to the 90% of right-handers. So it's very, Josh, what you're talking about, I think is important. It's important for you, but it's important that we get this right, because the other three big parts of the financial industry do not have this problem of attracting minds and VC capital, okay? Insurance doesn't, investing doesn't, and regular banking doesn't. They're so gigantic. People every single day are going to be looking at ways to service them and make money doing so. Credit unions are we're the left-handers. We're the 10%. Our fund is 10% of what FDIC's is. So we can't afford, the credit union writ large cannot afford to do anything that pushes away potential interest, because it's already the left-handed. We're already the thing that's smaller and less common. So I just want to say that, but ping me directly if you need anything.
No, we haven't. I just want to be clear. We haven't run into any. We haven't run into any issues. I just know there is that sentiment out there. I know you mentioned it in your speeches before that the reason places don't get into it is because of fear of the regulator. It's not even NCUA. I mean, so there's 50 different state regulators out there, or I mean, give or take, different state regulators. And I think the more that NCUA standardizes what they're looking for, which NCUA has done a very good job of doing, I think it helps the states as well, and we all kind of do things the same.
Yeah, and listen, I'm a huge fan of the dual charter system. I wish all 50 states had state charters. I think it's one of the only forms of competition we have in a way at NCUA. Competition is good, but it's not just fear of getting in trouble. There's that, or getting your hands slapped. And it's like, wait, why ruin a perfectly good exam with this other thing that we haven't even really started yet? It's just that you have it's not just getting in trouble, it's you have other things to do with your time and money.
Mm-hmm.
You got my project and I want to do this blockchain related thing, and then you got Keenan's project, which doesn't have any regulatory issues. All else equal, if I'm the CEO, that's going to tip me. Let's take our time and money. There's two things in this life, right? Time and money. Most of us are short of one or both. And
absolutely.
So it's going to tip projects. It's not just fear of getting in trouble. I mean, if you're not breaking a rule, how much trouble can you get in? But it's I don't want to put time and effort into something and then find out when I had other things that added value I could have done. So regulatory clarity helps tip the balance, and you can decide based on what you think is best for your credit union, not what's going to have fewer raised eyebrows from the examiner.
Absolutely. So, Christy, question for you. As a chief compliance officer and coming from both banking and having crypto experience, I think you have a little bit of a unique perspective here. So, if you were to talk to or give any advice to compliance officers at credit unions with your blend of both banking and crypto background, what advice would you give just generally to a compliance officer at a credit union when they're being asked to help, manage the diligence for a digital asset solution?
Well, as I mentioned before, bringing them in the first conversations, any new product offering, the compliance officer has to build policies and procedures surrounding the complete product offering to ensure their risks are mitigated and identified, and the risk assessment is reflective of the new product offering. Education is key, and I hope that in my position here, I'm able to bring in that type of education because I have transitioned over to the digital asset compliance BSA AML investigations piece, which is what they're going to have somewhat of a learning curve. Once you open up the buy, sell, hold into balance transfers and transfers in and out and cross border, that's going to be a big learning curve for the compliance officers and their team as well. So they need to be aware of that.
Absolutely. And just to elaborate just a little further on that, just speaking to buy, sell, hold specifically, since that's where a lot of credit unions are starting. This is just such a new thing for most credit unions and especially the compliance officers in the credit union. So where's a good starting point for a compliance officer at a credit union to really get educated? And we've talked about education, but if I'm a compliance officer at a credit union, where do I start to ramp up my own knowledge so I can be an effective compliance officer when managing diligence on a new digital asset solution?
Webinars are a great tool. Bitcoin 101, anything to give you a base understanding of digital assets. And of course, we're rolling out with just Bitcoin. So I would start there and understand blockchain technology. But with the buy, sell, hold solution, the counterparty is already known. The custodian is the counterparty. So for the compliance officer to review and investigate the transactions, they already have that process in place in reviewing the DDA accounts, the savings and the checking. They'll ultimately know where those funds are headed to because they have enrolled in this program with the counterparty, the custodian. So it's a very limited risk in my purview with the buy, sell, hold solution, because you don't have those external transfers in and out with these unknown FTXs or Coinbase or these high risk wallets coming in and out of the ring fence solution.
It's a closed circle. Right? Yeah. Chrissy, you might ask, once people have buy, sell, hold, is anybody talking about small dollar loans against it, like margin loans? In banking, credit union world, overdraft fees are politically, they're political football. And, people get payday loans and pawn shops and all that. People are talking about, and some may be doing it already for all I know. Let's say today's Tuesday and your rent's due, but you don't get paid till Friday. If you had all of your choices are bad, right? Overdraft fee, or the way people say we're waiving overdraft fees, that means they just don't pay it. So now your landlord's going to hit you with a late fee, right? Or you go to a payday loan. None of the options are good here, right? But if I had, if I was short $100 and I had, $1,000 in Bitcoin, whether I bought it directly or got it through my 2% Bitcoin rewards card, with a mouse click via my credit union app, if I was if I bought my Bitcoin through my credit union, in theory, you could borrow, say, 30% on the dollar. Let's just keep it conservative, right? Borrow $300 at a mouse click at even now a single-digit interest rate. Now, the loan, the way the capital rules work, cannot be a collateralized loan from a capital weighting standpoint, okay? But that is a solution to it, and it's something the wealthy have done forever. I have a margin loan for my brokerage account. It's the only reason I could buy this house before I sold my other one, right? It gave me liquidity. And you can't default on it. There's no debt spiral like there is with payday loans. And may I ask if anybody's doing that or talking about it?
I know it's on CryptoFi's roadmap, but Patty, you're nodding your head there. Why don't you add some color since you're probably talking to more credit unions about it than we are?
They're definitely talking talking about it. I think the question is just making sure you've got access to the keys in case you do have to pull that money through. If they do default on the loan, or if the market dips or anything, you got to be able to have access, which goes back to your policies and procedures. But definitely, it's one of the next biggest, we think the next biggest use cases is the lending part of that. And there's a lot of different areas around the lending. You know, again, if I have 50,000 in crypto and I want to buy my son a car, can I use that as collateral, buy my kid a car and pay it back? If I, you know, and the payday lending, all of those are such great examples of small dollar, because it gets people who have been underserved for so long out of that vicious cycle of payday lending and all of those different areas where they're paying exorbitant fees. This offers such a great opportunity to do it. So yes, people are talking about it. I think there's a few that are slowly getting to the point where you've got a CLO, a chief loan lending officer, that's going to be comfortable with doing it.
If I was going to do it as a credit union, this is just, you know, me talking, I would do experiments first and see it work. Yeah. Like, you know, I would have the executives, you know, the CEO, you know, get $100 loan at whatever the max LTV is. And then it's actually hoping at this point the collateral declines because you want to see it work, right? And then see it paid off, because again, one of the advantages of this is there's no debt trap. You don't have to refinance it, right? And these are tools that the well-off have used forever, liquidity issues. That situation where, you know, your rent's due today and, you know, you're going to get a penalty if it's late and you don't get paid till Friday. Well, that's already your money. In most of this country, like the government, we're paid a week in arrears, okay? So it's work you've already done. It's money somebody owes you. It's just a time gap. The wealth and the penalties are brutal in a whole bunch of ways, and credit score, et cetera. Even when they say we're not going to do overdraft, we just don't pay it. Okay, fine. You didn't charge me a $30 overdraft. My landlord now charges me a $300 late fee. You know, these are tools that the elite have used forever to deal with these liquidity issues. Like me when I bought this house and hadn't sold the other one yet. And to get these to the masses, but I would experiment, make sure it works. Play around with it, have a beta test, that sort of thing. Make sure, like you said, it can be executed. They can sell it, pay it off. Make sure that the credit union member can see, you know, live all the time. You have this loan for, you know, $100, and then if it's paid off, that they can see it. You know, you don't need me to tell you this, but I would just do a lot of small dollar experiments to make sure it works first. Yeah.
And the
absolutely.
The byproduct of a lot of these different use cases are the financial institution finding ways that where cybersecurity and fraud and things like that start to lower. And now they're even able to offer loans with better rates or deposit loan accounts with better rates because they're lowering a lot of the other areas.
Absolutely. And we're at time right now. Real quick, Mr. Vice Chairman, I want to give you the opportunity to give a closing statement here, but if anyone has questions for any of the other panelists that are on here, there'll be an email that's sent out along with the recording of this session, which you can go back and review. But Mr. Vice Chairman, appreciate you joining us today. So I'll leave the last 60 seconds for you. The floor is yours.
Well, the four of you know the space better than I do. So when it comes to, I should thank you for, you know, letting me learn from you. But to any credit union people out there, listen, I'm very easy to find. I'm on social media. If you ping me on LinkedIn or Twitter or anything, now I'm going to reply. Please email this to khauptman@ncua.gov because I have to communicate. You know, I have rules on that, but I'm very easy to find. And if you want to speak to me privately, we can do that. We've had this happen where somebody mentioned an examiner, and I don't want to get anybody in trouble. I just mentioned to the people who run the examination program, hey, this is something you want to tell everybody and make sure I see it. You know, and that sort of thing. So you can hit me up directly with these questions. I know this technology is going to morph into things that at least I can't think of right now. I remember the internet, it was a series of web pages that had stuff on them. And now the internet means something else. When I use an app on my phone, I don't go to a URL, but it's still the internet, right? So I think this is all going to morph into it. But credit unions have always innovated and to survive, and we think they're definitely going to have to again.
Very good. Well, appreciate everyone's time, and there'll be follow-ups coming from this, but excited about where credit unions are headed with digital assets and blockchain, and it'll be exciting to see this evolve over the coming years. So thank you everyone for participating and joining us today, and have a great rest of your week.
Thank you.